Welcome to Billionaire Business. My name is Ian Fishwick. I was an MD or Chief Exec in the UK IT and Telecoms industry for 29 years. I had the honour of reporting 29 consecutive years of rising EBITDA, which is operating profit.
And my name's Chris Godsmark, and for the last 2 decades or more, I've been advising tech companies, telecoms companies with valuations of up to $1 billion and more on mergers and acquisitions and fundraisings.
What makes a bank say yes?
I think this is a great bit of advice for companies. When am I ready for debt, or should it be equity? If you've got a product that works and you've got customers that are willing to pay for it, then you're ready to talk to a bank. You know, if your product doesn't work yet, or you haven't got customers that are paying for it, it's still probably equity.
Too early.
Yeah, it's too early. So you can waste a lot of time chasing money that you're not ready for debt, for example. Yeah. So, you know, a product that works and customers that are willing to pay for it.
In this series, we're trying to explode the myth that you just can't create the next £1 billion business in the UK, because it's simply not true. In some episodes, we'll talk to people who've done it to provide inspiration. But in others like this one, it's all about how do we help the next generation. So today, we have a fantastic guest. Welcome to the head of the technology, media and telecoms team at NatWest, the largest bank in the UK, Neil Bellamy.
Hello, gentlemen. Nice to meet you.
Good to see you.
Neil, thanks for coming in. As an entrepreneur, let me give you a bit of my background in terms of banking, because this is all about learning about business banking. You know, I did business studies at school, then I trained to be an accountant. Then later in my life, I did an MBA. Nobody ever taught me how to talk to a bank. And I must admit, when I first set up, I'd never even heard of sector specialists. I assumed that I would have to deal with a local bank manager. So can we just start with, explain your sector team and how many other sectors are there inside a bank as big as NatWest?
Yeah, it's good. It's a good tip for your audience, really, because there are specialist bankers out there for most of the major banks. So I head up the tech, media, telecom sector for NatWest, and we have about 100 across the UK, and then we've got other sectors in things like manufacturing.
What, 100 in your team?
Yeah.
Oh, wow.
And in my sector, we're mainly based around the major cities where tech companies, TMT companies cluster. So the main cities of the UK. But that's not always the case for other sectors. So, there's an agriculture sector, manufacturing, professional services, retail and leisure, etc., etc. But here's a great tip for your listeners to seek out really your local sector specialist relationship manager. They tend to start in NatWest. They start around turnover of about 2 million. It's just purely a cost to serve model, really. That for startups and micro businesses, you can self-serve really. You get into around 2 million, especially for tech, media, telecom companies that are high growth. We provide that sector specialism. Other banks, it's a little bit higher. For some reason, we were talking, weren't we, it's about 7 million for some reason. I think that might be an SME classification.
Can I ask a really stupid question?
Yeah.
How would I find you guys as a sector specialist?
Yeah, so for NatWest or other banks, if you Google, if you just do an internet search for, if you put in NatWest technology or NatWest TMT, you'd find my pages. I don't like to advertise the other banks, but you could do the same for the other major banks as well, if I'm honest. The other banks are available. Obviously not quite as good, but there are. You can then get into the bank at a sector level and start making contacts that way.
And give us a sense of how big your patch is. I mean, how many companies are you working with? And also, what does your day involve? I mean, do you spend most of the time prospecting new companies, or do you sit on boards of businesses? How does it all work?
Oh yeah, I'm very important, as you can tell. So no, not at all. We've got about 25,000 clients in the sector.
Wow.
And that so we are the lead bank in tech, media, telecom in the UK in terms of market share, but also lending.
But that is an incredible number of. I had no idea you. Yeah. I thought you were going to say maybe 2,000.
Yeah. And that's everything from startups, micro businesses, university spin-outs, mid-market, and all the way through to we're bankers to the large US big tech. So my role it's fantastic. It's the best job I've ever done in banking. I've been doing it 10 years. I've set up the sector for the bank. And I guess the buzzline is I'm responsible for the bank's strategy, proposition and risk appetite for my vertical. And my colleagues in other sectors do the same. So it is a fascinating job. One minute I'm doing sort of mentoring. I do some stuff for Imperial College and university spin out stuff where I do mentoring for Imperial Ventures. The next minute I could be kind of signing off on a big deal for Amazon, Microsoft, and everything in between. It's brilliant. It's brilliant.
So if you're setting the kind of TMT strategy for NatWest,
Yeah.
what are you looking for? I mean, what kind of businesses would you say, I want to deal with you? Which ones do you say, no, that's not for me? Apart from size, apart from the 2 million revenue limit.
Yeah. I mean, obviously, at the big end, I'm not going to add much value on this conversation. It's investment grade lending. It's big kind of stuff. Where I add most value and there's most interest is in that scale up and mid market area. So I mentioned earlier on sort of that 2 million revenue area, and businesses like your business is in. I'd love to have banked that. 19 years of, was it 19 or 29?
You did at the end.
Yeah,
You did for about 10 years.
Oh, good news. But yeah, those scale up businesses where we can, add real
But what
value.
are you looking for in a business? What makes a bank say yes?
Yeah, there was a bank that used to say that, wasn't it? I can't remember who that was, but no, I think the fundamentals of debt lending are that we are looking for management teams, good management teams that are looking to, accelerate their business. Looking for where we add most value as a bank is leverage. So debt is a form of leverage. You take our money, you invest it, you put it to work, and it helps you grow and accelerate. The difference between our product, if you like, our money and equity is I'm not taking a stake in your business. I'm investing in your business with loans, with debt, to help you scale. But I'm taking a debt risk. That's the main thing I explain to people that are scaling up. So I don't get a benefit of the upside like private equity or venture capitalist. So my tolerance for risk is a lot lower because I'm lending at a margin of, let's say 3 or 4 over base rate. In that 4% margin, I've got to have all my bad debts written off and covered. I've got to cover the branch network, to keep the lights on, the staff costs, and then leave a bit at the top for a bit of profit as well. So that's why banks are looking for a lower risk tolerance than equity. So it's got to be. And I think this is a great bit of advice for companies. When am I ready for debt, or should it be equity? I say quite a lot to my companies that are spinning out of universities and scaling up. If you've got a product that works and you've got customers that are willing to pay for it, then you're ready to talk to a bank. If your product doesn't work yet, or you haven't got customers that are paying for it, it's still probably equity.
Too early.
Yeah, it's too early. So you can waste a lot of time chasing money that you're not ready for debt, for example. Yeah. So, a product that works and customers that are willing to pay for it.
And how many companies would come through the door every week or month, and what percentage would you lend to? What's the sort of hit rate? I guess that might vary with the market to a certain extent, but
it does.
How does that all work?
Yeah, no, this is a frustration actually for UK scale up and business. The debt propositions we see, our approval rate is incredibly high. Really, really high, higher than 9 out of 10. Almost like 90% of deals we look at, we don't decline enough. So there's a real problem, I think, in the UK ecosystem. I completely get it. Actually, people are scared to ask for something they might get turned down for. I wouldn't want to do that. My frontline bankers also don't like putting stuff forward to their credit teams, that might get declined. So there's that culture piece actually of we don't like to look
the
at
ones
stuff.
that are likely to fail. never actually formally come forward.
Yeah, that's right.
That's
Yeah,
partly why it's so high.
yeah. So our approval rate is really, really high because people like a sure thing, don't they? And
Can we just talk about security for a minute?
Mm.
I mean, in my personal life, for a long time I had a mortgage. I understood that if I didn't pay it back, you could sell my house and get your money back. It was a physical security. Right? And obviously, the UK economy is like 75 to 80% service industries, right? So at the small end, are you after personal guarantees from people, or how does the security bit work? Because that frightens people a bit.
It does.
I might lose my house.
Yeah. No, I've reputationally, I think if banks never took another personal guarantee, it'll be a great day actually. And I think this is a great way, and I know it's something you want to talk about, but it's something I was very keen to develop, and I'm a bit of an evangelist for intellectual property, intangible assets, because you're absolutely right. The UK economy, the new digital economy, is not built on bricks and mortar, on machinery. The best companies that I see.
Let's come back to IP in a second, because that's a little more complicated. Your normal service industry in IT, telecoms, media, how do you handle that security problem?
Yeah, I mean,
is it just cash flow forecasts?
And that's really the point. Really, is their balance sheet is not made up of tangible assets, and actually, if we quite often see companies that are investing that are service based, built on ideas and innovation, they don't need to invest in a big property. And I have questioned some software companies. Why are you buying that? Why are you buying that property? That capital is much better invested into intangible. Yeah. Unless it's in their pension. Yeah, maybe I get that. But, software companies that are buying big flagship offices with fountains outside is a waste of money in my view. So, it's, the best, the best businesses in the UK now and globally are built on ideas and innovation, aren't they? So, there is that conundrum, and there is that market failure, actually, you could probably go as far as saying, is that IP-rich businesses that are rich in intangibles, find it harder and more difficult to raise and more expensive to raise debt. But actually, conversely, they're a lower risk. So that's why I call it a market failure. And that's why I'm much more interested in lending
because
against...
Because the IP is an asset, effectively.
Yeah, these empirical studies we've done, the BBB and the IPO office have empirically compared probability of default, and then i.e. how likely is this company to get into trouble, and if it does get into trouble, how much does is lost. IP rich or innovation rich businesses are lower metrics by quite a low way.
What we mean by intellectual property? Does it mean something where I've got a patent for it, or I've got a copyright for it? What do you mean by intellectual property? Yeah,
good message to get out there, really, that it's not just patents. I think the stereotypical view of intellectual property is, it's just patents. That means it's university spin-outs, and they're working on lots of heavy R&D, and that's really not what I see day in, day out on in my lending propositions and some of the best innovations.
What does it look like?
So I think those businesses, it's a blend. The best IP is a basket, because it could be patents, it could be copyright, it can be brands, it could be contracts, it's software, definitely it's software, it's trade secrets, but it's people as well, and it's management teams. So I lend to businesses. I'm not really lending to a patent. I'm lending to businesses as a whole. So the best businesses that are a combination of all of these things. And when I'm lending to them, I'm considering all of those things in the round.
But how on earth do you value it? I'm just trying to, because I guess what you're saying is, traditionally we would think of you lending to businesses which don't have physical assets like buildings, basically on cash flow. You're looking at cash flow. What you seem to be saying is it's a blend of this richer sort of melting pot of different factors.
Yeah.
How do you put a value on those?
Yeah. I'll step back 30 years when I started in banking, because I think this story tells what I'm lending against. So when I first started lending in banking, outside of commercial property or someone's house, the best asset you could get hold of was a print press. It was 30 years ago. It was when print was moving from lithographic to digital print, and the Ferrari of print presses was a Heidelberg 5-colour print press. You know, £1.5 million, 2 million quid's worth of print press that any asset financier was like, oh, look at that lovely bit of hardware, you know. And I remember lending against these things, and it was fantastic. But if you think about that print press sat alone inside a warehouse, sat idle, with no one operating it, no contracts to print anything. It's just a lump of metal. And that's the same with intellectual property. You know, I'm not going to lend against a patent if there's not any revenue coming off of it, or great management teams running that businesses, or a domain names, or brands, or copyright, you know, or software that makes it all work. So it's the same concept, really. I'm looking for innovative companies that have got intangible assets in that basket. But I can only lend debt. Coming back to my first point, you know, debt and that low risk, it's not for pre-revenue businesses.
But the bit I'm struggling with slightly is, let's say it was an office. You know, I know what the value of that is. You might say to me, well, I'll lend you 50 or 60% of the value of or whatever, right? How do you decide, back to that point, you know, what is the value and what percentage of that value would you lend?
Yeah. Because I guess
how much can I borrow?
For the layman, you know, we all understand what a residential property is worth. We could probably get a little idea on a commercial mortgage, but equally, I could also challenge in economic cycles how much money banks and the economy loses on the boom and bust of property assets in particular. We lose a fortune on commercial property in particular. So I would challenge that assumption that lending against property is safe when we don't lose any money. We lose a lot of money against that, banks. But yeah, valuation. How do we value it? So we work with a company called Ingot, and they've built a sort of an online platform that we value. And there's a lot of internationally recognised standards on valuing IP that the big four accountants have all agreed to, and a lot of it is all to do with discounted cash flows.
Right. Okay.
So we take a view of three things: market value, a multiple of EBITDA, of profitability, that's usually the highest. A cost valuation. You know, if I was to go and buy this IP or this intellectual property, if I had to go out and buy it now, and that's things like how much are you claiming on your R&D tax credits, how much does it cost you to build that software platform? That's the lowest one. And the one we lend against really is orderly disposal value. So what's that IP worth in situ within its business that it's operating normally? And if things started to go a little bit wobbly, you know, we could sort of stand back and go, okay, what would someone be interested in buying?
If I understand this correctly, it is if I don't pay you back, you're not going to take over my business and do a fire sale. You'll take it over in a controlled manner and in an orderly sale process. What could it be sensibly valued at based on a discounted cash flow?
Yeah, absolutely. Yeah, we've got no, you know, look, NatWest, we're previously government owned. We're the number one bank. You know, we're not interested in taking over people's businesses and trying to fire sale stuff. It's kind of business as usual for us to work with businesses if things don't go quite well, to try and work, first of all, turn it round, work with people to get things going in the right direction. But yeah, if things aren't working out, you've got a valuable asset there in IP, in intangible assets that are worth the most if you could sell the business as a whole. You know, so everyone's interests are aligned in that instance, that for the business, you know, and the bank, you know, to keep things running, the staff there. So yeah, that's the kind of basis we look at it, and our IP loan is kind of off. We lend up to kind of 50% of that orderly disposal value. So you know, it's
value in a sale.
Yeah, in that valuation, it's ODV, orderly disposal value. So it's not software companies could get, I don't know, 14, 15, 16, 17 times a multiple of their EBITDA. That's the market value. We're not lending against that. The orderly disposal value will be lower than that, and we're lending at 50%. So it's not massive, mega leverage stuff, but it's kind of groundbreaking. It's kind of no one else is doing it in the world.
At this point in the show, we wanted to just pause for a minute and tell you about our sponsor for this series of Billionaire Business. Nets International is a global systems integrator and solutions provider with over 40 years of worldwide expertise in telecom, digital and infrastructure solutions. Nets operates in 7 countries with 3,000 plus projects delivered across 26 nations worldwide. From fibre and mobile network rollouts to enterprise IT, cloud, cybersecurity, automation and managed solutions, Nets delivers smarter, faster and scalable solutions for its customers. With over 1,000 certified and skilled professionals and their own Nets Academy, Nets not only builds infrastructure but also offers managed services and flexible resource outsourcing to help businesses scale with confidence. Recognised as Cisco's Emerging Partner of the Year and Best Fibre Services Provider in the UK, Nets International is the trusted partner driving digital transformation and leading the charge in integrated solutions worldwide.
So if we said to people who are watching and listening to this, on that kind of business, run a discounted cash flow on your business, use something like 10%, I don't know, as your discount rate, and then half that, that'll give you a quick fag packet idea of how much you could borrow. Is that kind of how it works?
Yeah, you could do that. I mean, it's. I think what's great. What's been the barrier to entry for IP lending is these things cost about 10, 15 grand to get a valuation. We've worked with Ingot to do it at 890 quid. So we've got some companies that are raising equity, or they're raising debt, or they're just really interested they've invested 5 million quid in their IP assets. They're interested for 890 quid plus VAT to find out what it's worth. So we've had quite a few companies go onto the platform and value it there. You can get a free appraisal. Have I got IP assets that are worth something?
So you can help.
You can just
understand.
You can just go on there and do it free for initially. But then if you want to go ahead, it's 890 just for doing that. The way we've made that work is because we also, the key point about lending against intangibles, it's they're dynamic. So we can't. It's bad practice to try and lend to it like an asset finance. So we don't lend and forget. So Ingot worked with us to monitor those intangible assets on a quarterly basis and revalue it on a annual basis. So we add 0.4% to your loan margin to pay for that, and that's how the metrics work really, to have such a low front end IP valuation. But it's been great. We've been able to do loans from 250k up to 10 million. We've done a dozen loans so far for companies that
on that particular
product. Yeah. And it's for companies that hadn't even considered debt before. It's helped them accelerate, employ more people, invest more into their intellectual property, to access new markets. And surprise, surprise, hopefully, they take our money, they invest in it, their IP goes up in value. 12 months later, they're starting to come back to us and saying, can we borrow some more? And that's brilliant.
And you've got a huge portfolio. I mean, I had no idea that it was that big. So that is a very good bellwether for
UK SME.
tech generally. But two questions really. One is, and they're related. One is, how often do things go wrong? And is that sort of very much cyclical as the economy goes up and down, or actually with such a big portfolio, you must have a lot of sort of metrics around, what could go wrong, when will it go wrong? There must be a lot of data that you're sitting on, Neil.
Yeah, and I can't disclose all of it because it could be a little price sensitive, but I'll give you, I'll bust some myths that my sector, tech, media, telecom, is not high risk. We're well below average.
What, in terms of business failure rate?
Yeah. So, again, assumption, tech companies, software's 50 years old for crying out loud, But some people in the banking credit underwriting think software's still new. So Microsoft's 50 years old.
So how many businesses do fail? Is it 1 in 10, 1 in 20, 1 in 50?
Yeah, so do you remember I was talking about margins? Yeah. So bankers lend at a margin over base, and each those percentage points have got to sort of absorb, bad debt. So I can afford, I can afford about 1% of my deals
So
to
one
go
every
wrong.
100.
Well, yeah. So out of that three over base rate, 300 basis points, 100% of that is really paying for the 1 in 100 that kind of goes wrong.
But when you say go wrong, obviously there are shades of going wrong. I mean, you can lose everything, but
Yeah.
that must be very, very rare that there is literally no recovery, because you've normally got the first call on the money. But what's the definition for you of going wrong?
Yeah, no, I think that is a point in the intangible economy that we are lending into, in sort of intangible lens that we've got, where we don't have security of historically of a building or a print press or a vehicle. Yeah, the loss given a default is higher in my sector. So they're lower risk companies, but when they do tend to go wrong, there's not usually much there unless you can sell the business as a whole, which is really why I'm such an evangelist for actually valuing intangible assets, lending against them, recording them, because I think there's a lot of value in there that quite often, not as banks, we don't ever get to see or record it or talk to the regulators about it because the business is sold or it's failed. So there's a point there.
About pricing for a second, because in a consumer market, if I want to borrow money on a house, I go on the internet and I can find out what price the mortgages are, and I can pick one, and they're all slightly different. In a business, it feels very much bespoke.
Yeah.
Right. And certainly in all the borrowing I did for a long time, it's pretty bespoke. So what drives the difference between those who get money relatively cheap and those who get money but they're charged a lot more for it? What's the big factors that drive the pricing? The interest rate, basically.
Yeah, to demystify that for people, the scale, it's price to risk and security in the most simplest terms. So to use your analogy of you as an individual and how you can access money, if you think about it, probably the most expensive way you can borrow money is on your credit card. Very, very ultra flexible, totally unsecured. They don't really know. There's no control about what you spend it on, where you spend. You're given a limit and you can free reign, really. So that's the most expensive. The cheapest you could probably lend against is against your house. It's you've got security behind it. There's a really solid understanding about the value of that property, and also the banks understand that you're highly unlikely to default on that because you live in it, and you're highly incentivized to keep up the payments. So they're the kind of the two
extremes.
Two extremes, really. And then you relate that to businesses. The earlier you are and smaller you are, you're probably going to be, and you haven't got any security behind you or a track record, less predictable. We're either not going to lend to you because you're too early, or it will be on the more expensive scale, unless you've got some secondary security you can put behind that, which nowadays banks really don't want to do, or if I was an entrepreneur, I'm not that keen on doing either. Which is why, a lot in my sector in particular, a lot of people are either operate from their own cash flows, don't borrow. It's a very low percentage of people borrow in my sector early on, or they're taking private equity.
Does that mean you give more credit to recurring revenues because it's more predictable?
Yeah, exactly. That's a reason why perhaps we do a lot. I do billions of pounds worth of software lending. It's an element of intangible lending where you can get a bit more comfortable because there's intangible things around it that make it more predictable. There's a contract with a large company usually. It's multi-year. That's more comfortable. It's recurring. It's mission critical. You're doing a bit of software to someone that if you turned it off, they'd notice it.
So how much are you lending each year? How much new lending
Yeah, so my sector at TMT, we lend. My book's about 19 billion. The last time I looked.
New
Pretty
lending
good.
each year or in
No,
total?
the book in total. And we every year I've looked after the sector. We've grown ahead of GDP because our sector is growing ahead of GDP. So some years it's been double digit growth we've been doing.
And what you would lend $1 billion a year, or
Yeah, that is roughly getting
Well,
around that.
5% is
Yeah,
good, isn't it?
yeah,
pretty
yeah.
good.
So there's been particular kind of sectors of tech media telecom that you guys will be familiar with, and the audience, where we've actually, part of my role is to spot opportunities. Yeah, that the risk appetite works. It's something we want to go after. So we were a big backer of broadband deployment
Of
to
fibre
fibre.
companies.
So
yeah.
you would have all seen your roads being dug up and people trying to sell you and compete with incumbents to selling your broadband. We backed quite a lot of that stuff, so that saw a big increase. Data centers is a big infrastructure and a big asset play we're doing at the moment. I mentioned earlier on we've been banking. We've been sort of UK European banker to quite a lot of the big US big tech names as well, and doing some innovative stuff there. Where I love and I think we add most value, and where I am really interested in doing is mid-market tech, telecom, software, ICT, managed service businesses. The UK's got some great businesses in there.
And when you say mid-market, what sort of size of loan
Yeah,
would that be?
Interesting for tech companies. I consider mid-market tech companies to be anything from sort of 2 million turnover, because you can get coming back to where we
What
really
size of loan would that be?
Yeah, where we started off talking about sector specialists. So my mid-market company and the money I can lend is different to my sector than it would be to agriculture or manufacturing or
Right.
retail and leisure. So the advantage of speaking to a specialist is, for a tech TMT company, they definitely have more sophisticated corporate level needs much earlier, and then they go through that life cycle quicker and accelerate quicker. So I could consider like 2 million revenue software ICT company. We can really start lending money to those guys quite quickly and see their acceleration. They could go from like nothing, 2 million, 10 million, 50 million.
But the sweet spot is bigger, isn't it? Presumably.
Sweet spot, I guess, for us as a bank, where we can really start lending serious money, is kind of £1 million EBITDA, £1 million profit, where we can start then getting much more sophisticated lending, higher levels of leverage, which is how many times per profit we can
In
lend.
your team, do you have technical specialists? I don't mean bankers. I mean, let's say you lend to a cybersecurity software company. Do you have people who understand the technology?
Yeah.
Rather than the accountancy of the banking. If you
Yeah, let's be straight with the audience. Really, I'm a banker that knows a little bit more about the technology
Yeah.
than another banker down the road. I think we're daft if I go into a really high-end cybersecurity company and say I'm a tech specialist. I'm not. I'm a banker that knows a little bit more about technology. It's a great saying. One of my bosses said to me early in my career: "Everything useful you learn about banking, you'll learn from your customers." And I think that's a great way of thinking about it. I know a bit about finance and funding. All the juicy stuff, all the good
We learn a
stuff
bit
I
about
learned.
banking.
Yeah.
I think we're in the wrong game. But and when a prospective customer comes in, what are the do's and don'ts? I mean, if a company comes to pitch to you,
Yeah.
what makes a good pitch? What makes a bad pitch?
Yeah, I think being prepared. We've seen this actually with this new IP loan, where entrepreneurs are fast paced and they really want things to happen and they want to go, but they haven't got the basics there of, for example, they're looking to me to lend against their forecasts, but they haven't actually done their forecasts yet in any particularly reading way. I'm not going to lend to you on the back of a fag packet because you tell me that you're going to do this profit. I get repaid from that stuff happening in the future. So you can do a little bit of work for me on having some decent plans and
Okay,
forecasts.
For a bit of fun, we're going to try and teach the audience about business banking as fast as possible. So we're going to do a quick fire quiz.
We have got a quick fire quiz for you. And Neil, I mean, you came out with a new acronym earlier, actually, which was it ODV?
Yeah, that for valuations of intellectual property, or orderly disposal value.
Orderly disposable value, which I'm going to remember and
it's a new one on me to
use again. But
yeah.
banking is full of acronyms,
It
so
is.
we have a very short quiz for you, and if given the time, a one-sentence answer, please.
Absolutely.
So the first one is: what is a revolving credit facility?
So in layman's terms, think of it as an overdraft. It's a flashy name for an overdraft.
An overdraft. That's a good one. Now, what is an accordion? And don't say it's something that you play on a seaside pier. Please.
Yeah, I know. It's it's agreement in principle to lend you money.
In principle.
Sounds good. Next one.
I've not got my glasses on, so I can't read that. So I'll make it up. Right.
Go on.
Right. So often when I borrowed money, it said, I'm going to pay Sonia plus a margin. What's Sonia?
She's a great girl. No, it's the new version of LIBOR. So it used to be called the London Interbank Offer Rate. If you're a small business, you borrow off a base rate. And SONIA is the new acronym, which I can't recall what it stands for, but it's the interbank rate, really.
Sterling overnight
Yes.
interbank account, something like that, isn't it?
It's
Right.
the rate the banks are
Right, so
lending
that's-
to
it's
each
a base
other
rate,
at.
is what
Yeah,
you're
it's the grown-up base rate.
And why do we say first and second lien, which we hear all the time? What does a lien mean?
Oh, this is back to my banking days. Yeah, lien is like a right to something. So if you, in layman's terms, let's put it, so you could have a first mortgage or a first lien on your house. So that's your first charge. You might decide to take another loan out with someone else that would take a second charge up behind that, and that would be a second lien or a second charge.
Whenever I borrowed money, he said to me, you've got to keep within your bank covenants, and one of them was interest cover. How do you calculate interest cover?
Yeah, that's quite a simple one. It's the interest rate you're paying per annum, just expressed by how much profit you're making. So we would typically say we'd want you to cover it 2 times. So if your interest cost was 50 quid, we'd ask you to make profits of 100.
So final question, there could be a prize at the end. When were you born, Neil?
1973. I'm a grand old age of 50
Who
plus.
won the FA Cup in 1973?
Ooh. I'm guessing now, and I hate to say it as a Spurs fan, I think it was probably Arsenal.
I think it was
Sunderland, you're right.
So
Sunderland. That was my second guess.
I said it first,
Ah.
so unfortunately you haven't won the prize. But Neil Bellamy, I have to say that's been an absolute pleasure speaking to you, and
Wasn't
also an
Spurs.
education on banking and reassuring that you knew the answers.
Yeah,
to all of our
thank you.
questions.
Yeah, because if my bosses are watching.
Neil, as ever, lovely to see you. Thank you very much indeed.
Thank you, gentlemen. Pleasure
Thanks.
to meet you both. Thank you.
In fair play to Neil Bellamy, I mean, this has almost restored my faith in British banking.
It makes you realise how big the UK is. I mean, you and I have been in the tech industry for quite a long time. Right. And I think both of us were a bit shocked when we said, how many customers have you got? And he said, well, just in the technology, media, telecoms sector, 25,000 businesses. This is huge.
That's incredible. And billions of pounds of exposure to sort of UK PLC, right?
Well, he's lending each year another £1 billion a year on average. Right. I used to think when I started that banks would say no to most people who asked them for money. And when he said, no, 9 out of 10 get approved, did that surprise you?
I mean, that's by far the biggest surprise. And there were a few surprises in that interview, right? But that was by far the biggest surprise because he's really saying, bring me more businesses. You would think he was deluged with businesses every year. He's saying, bring me more and I'll lend to them.
I think the key lesson was when you talk to the local bank manager, they'll quietly tell you if you're not ready. Don't bother putting it in because that's not going to fly. So if they say, yes, we're ready to apply, that means that you've already kind of been through the quick sanity check on it. There was probably the biggest bit of advice for me, I think, was how big do you need to be to get a loan approved from a major bank? When are you ready to borrow from a
from
bank.
the specialist team.
Yeah.
You know, he's running the tech team, and I think he said sort of 2 million turnover. You know, my thought was before we met Neil, you'd need to be a relatively big business, you know, 10 or 20 million of turnover before they, as a specialist team sort of client,
I mean,
they just wouldn't be interested. That wasn't the case, was it?
He was suggesting that even the other banks are about 7 million and he's at 2. Although he did say the sweet spot that he's really looking for is people around about 1 million EBITDA. Now, if you don't like EBITDA, operating profit, right? But it does show you that you don't need to be as big as you think.
I think it also shows you, you know, there is help out there from the banking system. You know, certainly from NatWest. There's lots of specialists out. They've also got the accelerator program, which Maxine Laceby went on in one of our other episodes, right, from Absolute Collagen.
Absolutely. And they're obviously trying hard to make sure businesses don't fail. That was another interesting one. We said, how many businesses fail to pay the money back? And he said,
very few.
Hardly any.
Yeah. So look, as I said at the beginning, they have restored my faith in British banking. Neil's got a huge portfolio, but he's very ambitious. He's obviously keen to grow the NatWest, you know, lending loan book.
Let's finish on one key lesson. You've been listening to the Technology Media Telecoms guy today. There are other sector specialists like this. So regardless of what you do, just Google and have a look and you'll find the specialist teams, right? Because that's much better than talking to your local bank manager.
Absolutely.